This is Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. Twice a year, Barron's Financial Magazine sends out their Big Money poll, asking professional money managers to provide their current thinking on the markets and their investment outlook. We usually find time to respond to the survey. It's fun to see the results and how our answers stack up with other firms. We spend a lot of time talking about valuation fundamentals, like how important revenue and earnings are to stock prices. Of course, everyone also knows, at least in the short term, nothing's more important than general opinion. For any investment to appreciate in value, as opposed to paying interest or dividends, someone with a bullish outlook has to want to pay more for an asset than you did when you purchased it. So there is value in understanding the sentiment of other investors, particularly other money managers that influence significant capital. For instance, 67% of respondents call themselves bullish on the next 12-month outlook for stocks. 25% said they're neutral, and only 7% said they were bearish. The survey was distributed back in late March. In that brief time between the distribution of the survey and its publication, the major indexes have surged 5 to 6%. So it's rather humorous that the bullish asset managers, when asked where the market would end this year, the average response was for the S&P 500 to close at 4207, which is a paltry 0.5% from Friday's close of 4180. We have never put much credence in predictions for where any index will end up, even from professional money managers. It's always wrong by a lot. If I told you that I'm bullish on equities and that I expect the S&P 500 to gain 0.5% this year, you should think my position is ridiculous. The outlook for the economy is really great. Travel is ramping back up rapidly. Employment numbers continue to improve, and with all the stimulus, consumers are flush with cash and there's pent-up demand. The problem is the stock market already reflects rapid acceleration in the economy this year. Professional asset managers are bullish, but they also view stocks as expensive. 38% of respondents said stocks are overvalued. 57% said they're fairly valued, and only 5% thought stocks were undervalued. Over the long term, equities should continue to move higher. Predictably, 64% of respondents expect stocks to return between 6 and 10% over the next 10 years. It should be no surprise that this is the same as the historical long-term average for equities. More interesting to us than generally inaccurate predictions of market performance are the perceived biggest risks to the U.S. stock market over the next 12 months. Truthfully, the biggest risks to the market are always unexpected. Respondents in the Big Money poll failed to identify the risk of the dot-com bubble, or a terrorist attack, or a housing mortgage crisis, or a pandemic. Regardless, the survey does show what professional investors are closely paying attention to right now. Inflation is number one, with 20% citing it as the biggest risk to stock prices. COVID is a close number two at 16%. Higher taxes are a concern, but only 13% cited tax hikes as the top risk to stocks. I want to return to tax increase risk in a moment. We would generally agree with this list, although excessive stock valuations relative to some of these risks are certainly a concern of ours. Another interesting part of the poll is the anticipated performance of various asset classes. Predictably, equities are expected to perform the best by a significant majority of 64% of respondents. It's worth noting that only 2% expect cryptocurrencies to be the best performing asset class. We are surprised that even 4% expect fixed income to be the best in an environment of rising interest rates. Current asset allocations among firms supports these views, with nearly 70% of assets in equities, only 17% in fixed income, 7% in cash, and only 5% of assets allocated to other asset classes. Our bullish expectations for stocks are based on what is, by all accounts, going to be a very strong period for the U.S. economy. Yes, stocks are expensive, but they often get even more expensive before the fundamental outlook changes, growth slows for any number of reasons, and a correction is necessary. I'm not going to bother to predict where the major market indexes will end the year, but we think stocks will add to already solid gains this year. This last Thursday, stocks fell with a media report that the Biden administration would propose tax increases, in particular on capital gains for individuals that earn more than $1 million annually. Also reported is the expected proposal to eliminate the step-up cost basis on death for inheritance. 3 points we want to make. First, this is not new news. We've been talking about these very same proposed tax increases since the election. It's always a little surprising how the market can react several times to the same headline each time it's trotted back out, even though it's old news. Secondly, there is a big difference between a proposal and what is likely to actually get passed. It's unlikely with the current composition in the Senate that the proposed hikes will become law in full. And last, while there is headline risk, everything from automated trading to spooked investors can send the market lower briefly, which is what happened last Thursday. Historically speaking, stocks have shrugged off tax increases. Here's a great chart from Bloomberg showing tax hikes and tax cuts, along with the performance of the S&P 500 since its inception back in 1957. Looking at the chart, we don't see a correlation at all between the changes in fiscal policy and stock prices long term. Look, certainly too much tax will retard economic growth and add friction to the economy. There has to be a balance of government tax, spending, and regulation to provide the necessary infrastructure to protect people and enable commerce. Exactly what is the right balance will always be up for debate. As money managers, we are instinctively resistant towards tax increases. Usually the government is not the best at efficiently allocating capital in the economy. However, we are likely to see some tax increase out of the Biden presidency, but it will not materially affect stock prices in the long term in our view. If you told us that the U.S. economy will go into recession next year, we would reduce exposure to equities. The specter of a tax increase is reason to reassess tax strategies around your investments, but it's not a reason to reduce exposure to stocks. So, bullish outlook, expensive stocks that can get more expensive still. We worry about an overheating economy and rising interest rates as a result. We will be hearing a lot about tax increases proposals, but the long term, there are more important drivers for stocks. Thank you for joining us. If you have any questions, comments, please leave them below.